Welcome to Close of Business. I'm Alicia Barry. All eyes were on interest rates this year as households and businesses struggled with the cost of living. At its December meeting, the Reserve Bank kept the cash rate on hold, but the RBA governor says the board's next move could be a rate rise if inflation doesn't begin to ease back toward the target band. Michele Bullock says there's a lot of uncertainty about how that will play out, but more rate cuts are not on the horizon. David Chow reports.
Like many people paying off a mortgage, Matthew Britland is watching his finances closely.
Every time we spend, we have to almost justify the spend. And so my expendable income, the spend on myself, things like Christmas, is just all reduced.
Matthew bought a house in Sydney back in 2024 when interest rates were at their highest in more than a decade.
I'm feeling mortgage stress. I'd like to go and see people in England, my family, I've not seen since COVID.
That trip may need to stay on hold for a bit longer, with no rate relief from the Reserve Bank and a change of tone from its governor.
It does look like additional cuts are not needed. The private economy is recovering, it's taking over from public demand.
The cash rate has remained steady at 3.6% for the third meeting in a row.
A lot of Australians would have wanted some more rate relief, but they wouldn't have expected it. There was, in the estimations of the markets and the economists, no chance.
Michele Bullock said the RBA board was not comfortable with the level of inflation in the September quarter.
Some of this looked to be temporary factors, but there were signs of persistence in some items.
Far from rate relief, Australian borrowers may need to brace for higher repayments. So what's the more probable outcome for next year? Interest rates going down or interest rates going up?
David, I don't think there are interest rate cuts in the horizon for the foreseeable future. The question is it just an extended hold from here, or is it possibility of a rate rise?
Money markets are now fully pricing in a rate hike by next June, with an outside chance of one as early as February. HSBC's chief economist for Australia and New Zealand agrees the central bank's next move is up.
Our reading is the economy's already in an upswing, that growth is already running a little bit faster than the speed limit that the economy has, and that's why we've seen inflation pick up recently.
The RBA is facing quite the dilemma. Inflation is still too high, which is normally remedied by a rate hike. But at the same time, the jobs market has been slowing down. Unemployment is rising, and that could be made worse if rates were to go up.
One of the consequences of that is likely to be that it would slow down private sector hiring. That would be one of the mechanisms through which you would be setting policy to try and get inflation back to target.
So consumers tread carefully over Christmas?
I'm not telling consumers what to do.
But she did have this warning.
If we don't get inflation back down to target and inflation expectations start to rise, then that won't be good for employment, because we will have to raise interest rates quite a lot more and we will have to hurt the economy more.
A stern message followed by a festive greeting.
Happy Christmas, everyone.
The change in tone from the RBA means at its next meeting in February, there's a real chance interest rates could go up. CBA's chief economist Luke Yeaman is sticking with his view rates are on hold for an extended period, but he says the risk is the RBA will have to step in and tap on the brakes in an economy that's picking up. I spoke to him earlier. Luke Yeaman, welcome to Close of Business.
It's great to be here.
We heard a rates warning there from Michele Bullock. Is 2026 the year inflation strikes back for good and rate hikes return?
I think it very well could be, Alicia. Here in Australia, interest rates and inflation are going to be the big story, at least for the first half of 2026. We've certainly seen a marked shift. If you go back a few months, it looked like inflation was back under control. But moving ahead, the economy is building up quite a head of steam, and we're seeing inflation start to outpace expectations. And if that continues, we could certainly see some rate hikes into next year.
Do you think there's a chance the RBA governor could be jawboning here, trying to get the effect of higher rates without inflicting the pain?
That's certainly part of the story. I think our general view at CBA is that the economy has started to approach its overall speed limit, but it hasn't yet crashed through it. And there's still a chance that growth will plateau next year at around trend rates and that inflation will gradually come back under control. And I think the Reserve Bank is watching closely, trying to see, are we seeing a genuine resurgence in inflation, or are we going to see inflation stabilise? And at this stage, our view is we will see inflation start to stabilise over the course of the year. But all the signs are pointing to an economy that's just a bit stronger than the Reserve Bank and we had expected. And if that continues, we could certainly see a need for the Reserve Bank to step in and tap on the brakes.
Now, I know you're a bank economist, but does this mean broadly mortgage rates are heading higher?
Look, I think it's still too early to say for sure that they're going to go up from here. And as I said, our current view is that interest rates are probably on hold for an extended period through 2026. But the pressure is building, and we're certainly not going to see any rate cuts.
And how will this play out in the property market, where home price growth has been pretty strong in 2025 since the RBA started cutting interest rates?
Yeah, we certainly saw house prices get a real head of steam up in the early part of this year, probably stronger than we had previously expected, and they're on track for gains nationally of probably 8 to 9% this year. That's quite a strong increase. But we are, as you say, already seeing some signs that even just the talk of higher interest rates has started to play through the market, and we're seeing auction clearance rates, for example, start to drop away a little bit. And we do think, one of the reasons we think there might not be a need for the Reserve Bank to step in immediately is because of the fact that talk of higher interest rates alone should help take some of the heat out of the housing market, should take some of the heat out of the consumer sector, which has been growing quite strongly over recent months, according to our own internal CBA data. And so that's part of the story. That jawboning might in itself help keep some of the pressure off interest rates.
It's pretty clear the RBA is more worried about inflation than the jobs market at the moment, which itself looks pretty tight at the end of 2025. Do you see any risks it could unravel in 2026?
I don't think so. I think at this stage our view is that the jobs market still looks quite strong. We've got internal data as well from CBA tracking employment and wages outcomes, and we are seeing still reasonably strong momentum in employment. And wages growth has been easing back a little bit. So at this stage, we don't see any obvious sign that the labour market is going to lead to major disruptions or cause concern for the Reserve Bank this year. I think the bigger thing to watch is if we do see a couple of continued higher inflation prints over the next few months, and if we started to see the labour market retighten, if we started to see trend employment and activity in the labour market start to strengthen, that would give the Reserve Bank more pause for thought. But overall, I agree that the primary focus of the Reserve Bank over the next few months going into 2026 is going to be on inflation rather than the labour market.
We hear a lot about the economy hitting its speed limit as it runs up against capacity constraints. Can you explain what that means and why it's inflationary?
That's a really important point, Alicia, and economists talk about the speed limit, but we talk about the potential rate of growth in the economy. How fast can the economy grow before you start to generate wage and inflation pressures, before businesses have to start fighting harder for workers and driving wages up, before they have to start fighting harder for materials and driving those costs up? And our estimate is that at the moment the Australian economy can probably grow at around 2.1% annually, around between 2 and 2.25%. And the reason that that number sits where it does is because it's driven heavily by productivity. And productivity growth in Australia, like other countries around the world, has been coming down over time. So the economy can't grow as fast today as it could maybe a decade ago without generating those inflation and wage pressures. And there's two important points to note as we see this cyclical upswing starting this year. One is we don't have much spare capacity in the economy. Normally when interest rates rise, the economy softens and there's a lot of headroom, a lot of spare capacity for the economy to use up before you hit that speed limit. This time around, we don't have that. We're still starting with quite a strong economy. And as I said, the second point is the speed limit has come down, and we would say, based on the latest national accounts data, that the economy today is growing at about that speed limit already.
As we head into 2026, what are the things that you're looking out for?
It's going to be very important to keep the international environment front of mind going into next year. We have a new Fed chair being appointed in the US. We still have a president in the US who is prone to some adventurous policy. We have tensions between the US, China and more recently Japan still in the background. And the other point I'd highlight is the AI boom. I think that's one of the big factors that started to impact growth globally and in Australia towards the end of this year. Going into 2026, I think there'll be a lot more talk around AI, both its impact on investment in the economy in the US, but in many other countries as well, its impact on productivity and its impact on businesses and jobs.
Luke Yeaman, thank you so much.
Thank you.
Trump, tariffs, AI and rates. It's been a wild ride for investors in 2025 and 2026 could be just as volatile. Daniel Ziffer takes a look back on what's been a big year and he has a crack at deciphering what's next.
2025 marked a new economic world order, marred by global shocks and trade wars. Fears of a US recession were replaced, with stock markets hitting record highs.
I think 2025 was the year of the up crash.
In a word, the past year has been a
roller coaster.
I think I'd run with enthralling.
In a word, I would say resilience.
China, 67%, that's tariff.
In April, Donald Trump's Liberation Day tariffs on allies and enemies shredded the global trading system that had delivered economic growth for decades.
And it really was panic.
It was a pretty big shock on the day that had happened.
That level of uncertainty, not knowing where things were going to settle, who was going to be affected with what tariff.
The Australian chief economist of global investment bank UBS, George Tharanou, was in New York as the announcement was made.
It was surreal seeing the markets move to meltdown amid the uncertainty of Trump's tariff policies. Investors we were talking to were seeing a very sharp correction in a lot of asset markets, equities and the Aussie dollar.
Audacious and slapdash, the tariffs even cover penguin-filled islands that have no human residents.
There was no logic in economics for those tariffs being levied at the particular level that they were put at.
We had the headline shock, and then markets clearly didn't like what they saw, had a bit of a correction.
Tensions between the world's big superpowers escalated before the Trump administration hit pause.
If there was one word that summarises last year, I think it would be taco. You know, the idea that Donald Trump will chicken out on some of his policies.
President Xi is a great leader of a great country.
The temperature dialed down and nations made deals.
We went from really worrying about what could have been quite large downside risks to global growth in the wake of what could have been a global trade war to something where those downside risks disappeared really quite quickly.
Locally, we had other problems. The Reserve Bank had held interest rates steady at 4.35% for more than a year, punishing those with large housing debts as it tried to force down inflation.
There was undoubtedly a lot of tension. We know households were really doing it tough.
Consumer spending slumped. Then, in February, came the first of 3 rate cuts after 13 hikes.
I think the pressure was there because we could see inflation was coming down. We could see the economy was really, really sluggish. If the bank hadn't cut rates then, it really would have been very difficult for them to explain.
For a while, it looked like inflation had been tamed, with price rises slowing to 1.9% in the year to June. Fast forward to October, and annual inflation is tracking at 3.8%, above the RBA's 2 to 3% target range.
The challenge has been that the recovery that we've got potentially is already starting to lessen the scope for inflation to fall.
Dashing hopes of further rate cuts and putting rate hikes on the table in 2026.
In all likelihood, inflation remaining above the RBA's target band over the coming months and quarters. And that's really going to take the period where they've missed their target to a 5-year long period, the longest on record. So I think begrudgingly, the RBA is going to shift towards raising the cash rate.
We think that a rate cut is still possible, but you need a lot of things to go right. We need to see the inflation numbers come back down again, and we know that inflation can run hot and cold.
The jobs market remains strong. The unemployment rate's 4.3%, and the economy's grown 2.1% in a year. Markets set new records in Australia, the US, UK and Japan, driven by the fear of missing out.
The higher the price, the higher demand. People just want to get into asset markets and not miss out.
Despite a recent dip, the ASX 200 is up more than 5% in 2025.
We've seen the interest rate cuts. We've seen profits, particularly in the US, continue to surprise on the upside. And even though conditions have been on the soft side, we've avoided recession.
Massive investments in artificial intelligence are driving global markets, propelling the so-called Magnificent Seven tech stocks most exposed to the boom.
These companies have genuinely delivered the earnings growth, and so that's a big difference from that tech bubble that we saw in the late 90s.
huge amounts continue to be invested in data centres, factories and technology.
I think that number is now close to $500 billion, which is a huge number, and I guess is forcing people to accept that this is a new innovation cycle.
With big money comes big risk.
I think there's a bubble. I think it may deflate rather than burst, but markets are stretched. That is no doubt about it.
So, what can we expect in 2026?
Volatility.
So I think it's just going to be another captivating year.
And I think the key question next year will be bubble or not.
The other word I probably use is uncertain. Or maybe the better word actually is just risky.
Risky business, indeed.
Well, how much risk will investors have to mitigate in 2026? I spoke to Kyle Rodda, market analyst at Capital.com. Kyle, AI was a huge theme in 2025. I imagine it's likely to be again in 2026. We were seeing jitters around valuations at the end of 2025. Is that going to continue?
I think it will. I mean, we have seen valuations moderate a little bit with some strong earnings as well as the kind of volatility that we've seen in equities that saw prices pull back. But we're not far off those high levels, and those high levels, depending on the metric you look at, were comparable to the dot-com bubble and the COVID bubble as well. I think this year for AI, with the way that markets are priced for things, and interestingly enough, the way that policymakers are talking about things as far as the hopeful impact on productivity and, of course, growth, is that the rubber really needs to start to hit the road for AI. The question comes down to, what will artificial intelligence do? Will it be a huge disruptor of labour markets that causes this huge increase in terms of the return on capital that investors see? Is it maybe something less exciting, still something a little bit useful, but perhaps not making that kind of path towards, say, artificial general intelligence or things that could, really change the way people do work, or perhaps even displace workers as well? So again, it's kind of getting to the point now where the rubber has to hit the road. Investors will want to see signs of that broadening out of artificial intelligence technology. So this theme's not going to go away. And again, valuations by objective metrics are high, and that conversation will persist while they are.
What should investors be looking out for in 2026 when it comes to the AI boom, the AI bubble, or potentially the AI bust?
Well, exactly. It's the notion that this has to start to deliver productivity gains and growth benefits. And the thing with market pricing and the way that I think investors often operate is that although, there is the notion this will be an impactful technology, that's up to debate, the scale of which that will be impactful. But there's also the timescale that we're talking about, and investors are impatient. If you draw sort of a parallel to sort of the dot-com bubble, valuations got incredibly rich. A lot of stocks delivered the return on investment that investors were expecting eventually, but rather than taking maybe 1 or 2 years, it took maybe 5 to 10 years for those returns to be actually delivered. And I think, again, if you look at what that actually looks like from a macroeconomic perspective, the Fed spoke about it this week, that they're expecting productivity gains to come through and sustain higher levels of economic growth, but still disinflation. Of course, investors are pricing in for, say, the Magnificent Seven stocks next year, earnings growth in different quarters, it could be upwards of 30%. So basically it's about, delivering the goods now, and that will sort of justify these valuations if they persist, or perhaps see them deflate.
It's possible we could see a differential between the US and Australian interest rates next year. That could be an interesting trade. What's the game for investors? Where do advantages lie?
Well, obviously, we might start to see that manifest in the Australian dollar potentially if it remains an interest rate differential play. There's an argument at the moment about what's driving, say, the US dollar, whether it is, interest rate differentials. And if that's the case, rate cuts in the United States would see the greenback depreciate. And if we see this potential rate hike coming through in Australia at some point this year, that will see the Australian dollar appreciate. So we might see the Aussie trend higher, especially if global growth does tend to pick up a little bit. 'Cause there is a lot of fiscal spending out there. There will be some rate cuts coming through in different parts of the world. That can be good for a growth-sensitive currency like the Australian dollar. The other side of that too, though, is that our growth outlook doesn't look fantastic. We don't have the artificial intelligence boom and the huge capex going on. And there's the notion that maybe that'll suck capital back into the United States and also support the dollar from that perspective. Ultimately, though, if you look at it from a macro point of view, we're not performing very well from an economic standpoint. That'll affect our asset prices, maybe not so much the Aussie dollar, but the equity market. the US still is performing very well compared to everyone else. So there's the kind of dynamics I think you can see from just not the interest rate side of things, but also the fundamentals underpinning the interest rate differentials too.
Well, in Japan, the potential for rising interest rates there could pose a threat to the money swashing around in equity markets and maybe even the dollar. Can you explain why that is?
Well, there is that big notion of the yen carry trade, and a lot of people will point at that as being, perhaps the crucial card in the house of cards that keeps global financial markets sort of propped up because of cheap liquidity and money sort of being borrowed in Japan and then invested in other parts of the world. I mean, it's probably overstated a little bit, but there is the notion that Japanese interest rates have been low for a very long time. That's allowed for a lot of leverage to build up in different parts of the financial system. And as interest rates increase in Japan, there'll be less risk money flowing around and will go back into Japanese safe haven assets, and that could compress valuations. So it's a significant risk. It has to be offset by the fact that we are seeing easing policy conditions in the United States and certainly other parts of the world. But I think one theme that will emerge in the year ahead is that we won't see such synchronized activity from central banks. Some will be hiking interest rates modestly. The Bank of Japan could do that very soon. Others might continue cutting interest rates modestly, like the United States, and that's going to affect capital flows and obviously volatility between markets.
Kyle Rodda, thank you so much.
Thank you.
A community in a Victorian country town has found a solution to prevent the sale of a historic property. Facing an uncertain future in a market with surging prices, residents have acquired it through a co-op. As Amelia Terzon reports, this economic model is becoming increasingly popular in regional Australia.
In this little country town, the locals had a vision to buy this 150-year-old building without going to the bank. The hub has got a community garden, it's got meeting rooms.
So there's 15 tenancies in this historic building, including a Chinese herbalist.
It's been such a long-term home to so many small businesses in Castlemaine.
But things were looking shaky a few years ago when the hub was put up for sale.
So I was a little bit worried that it might not continue.
So you were worried you would be kicked out?
Yeah, I was a little bit worried.
Other locals were concerned too, so they hatched a plan to keep this building in the community's hands.
We were sort of motivated by both risk and opportunity, really. So the risk that a commercial property investor would buy it, we wanted to take this property out of the market permanently and have it managed by the community for the community.
Why not just go to a bank and get out a loan and buy this with just a few of your mates?
Well, because of that bigger vision, which is about economic democracy, really.
Warwick and the other locals decided to form a cooperative. That is where individuals pool cash to buy an asset or run a business.
So the local council also supports this co-op. It also just brought in a strategy that prioritises a well-being economy.
It's about putting the power back with the people. It's about making sure that community owns assets within the community. So putting your money where your mouth is, really, and it's about making sure that the assets stay in the community and it's not taken by like a multinational.
Merrin says there's already a few co-ops in Castlemaine, but this was one of the community's most ambitious. They needed almost $2 million to buy the site. Warwick says that interest built over time and eventually more than 300 people chipped in.
What was the smallest amount you got from people?
$500 was the smallest that people could put in, and $500,000 was the maximum, but nobody put in anything like that. It was lots and lots of small
What was
amounts.
the biggest?
The biggest was about $100,000.
Whoa, who was the 100,000?
Well, that's confidential information.
Give us a tip on why they were passionate about that.
I think lots of people in this community really recognised what's happening to the town in terms of kind of gentrification and prices going up, and saw the opportunity for community to have some say in what happens here and the sorts of businesses we have here.
All investors agreed to fixed returns for loaning the cooperative money, and many of them are passionate enough to turn up to its meetings.
Cooperatives do require some admin. Every person who's invested, no matter how small or how big, has voting rights that are equal. This is Castlemaine Co-op's annual general meeting where people are going to vote on what happens in the next year. Are you the secret $100,000 investor?
No.
Why did you invest?
a strong family belief in community investment cooperatives.
And you get 3 to 4% return, apparently.
4.5%.
Why not just buy assets with the bank?
Because you need to put money back into the community.
Also in attendance is the Hub's former owner of 19 years. When you were getting ready to sell it, who did you think was going to buy it?
Well, we hoped the co-op, because they floated the idea with my husband and I a couple of years ago. We just said, yeah, suits our values, and so we were really excited about it.
Did you give it to them a bit cheaper because they were a co-op?
Definitely.
The building went into the community's hands as a co-op in September, sparking celebrations in town. And the festivities are continuing.
They're being used to run everything from credit unions to supermarkets to communities buying their own pubs. They're actually so prevalent that you might be a member of a co-op without even knowing it. Around 80% of Australians are.
One of the 80% is Emma Brinkman after she took a punt on her new landlord.
I'm a member of the co-op. I mean, a tiny little member, but it just feels really good to be a part of it. Number one thing is that I feel really grounded here. I feel really secure and like my business can continue.
What's it like to do this without a bank?
It's awesome. Yeah, on so many levels.
People power determining the future of their communities.
And that's all from Close of Business. This is the final Close of Business in its current format. A big thank you to our long-running and very talented supervising producer Simon West for his hard work on the show. Close of Business on Fridays will be returning in an online format in 2026. You can still find us on iView and on video on demand platforms. And you'll still be able to watch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV. I'm Alicia Barry. Thank you for watching.